The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery from Resi Home Loans, filling in for Margaret Lomas. And tonight, as usual, the panel and I will be taking your calls and answering all your emails on all things property. We have a great show for you this evening, complete with all the information that you need to begin or to continue your property investing journey. I have two excellent guests joining me, so if you would like to get in on the conversation, simply call us on 1300 30 34 35 or email us at property@skynews.com.au. Let's start the program with the news of the week. And according to the Property Observer website, the Gold Coast market could be showing signs of improvement, with Ray White Surfers Paradise reporting to have sold 7 out of 10 properties up for auction on the Gold Coast at the weekend, with more than $2.5 million of sales. 3 of those properties sold before auction, and Ray White Surfers Paradise CEO Andrew Bell says buyers seem compelled to act sooner rather than later. He went on to say that the result bodes well for local real estate and shows buyers no longer expect properties to languish on the market, so they're jumping straight in with offers vendors can't refuse. He added that competitive bidding of late has seen many properties selling well above reserve, including one property which achieved a sale price 26% above reserve earlier this month. A recent CBRE report says things are looking better on the Gold Coast. The Gold Coast market is finally stabilising, with perception of good value buying having boosted the prestige market in particular. However, the new unit market remains fragile, it said on Tuesday. Heron Todd White's latest report also supported this view, saying Central Gold Coast is firming up. With me tonight to discuss this and answer all your property-related questions is Brad Beer from BMT Tax Depreciation and Dr. Andrew Wilson from Australian Property Monitors. So if you have any questions about property, depreciation or finance, just call us on 1300 30 34 35 or email us at property@skynews.com.au. Gentlemen, welcome to the program.
Hi, Lisa.
Hi, Andrew. First time for us on this show.
It is, yes. I'm very excited.
Oh, so am I.
I can tell.
Should be a great night.
Yeah, sure.
And Brad, we're old hand at this, aren't we?
Back again. It's good to be here.
And of course, Margaret isn't, because she's away in Cambodia with some of the other Your Money, Your Call regulars, building houses for the Tabitha Foundation. I think they've raised more than $60,000 to do that. So I think they'll be having a great time over there. I think there'll be some building and some fun along the way.
Balance is what life's all about, isn't it?
It is indeed. So look, that first story that we mentioned tonight.
Yes.
Let's talk a little bit about the Gold Coast market, because it's a market that we often get questions about here on the show. And the Gold Coast has obviously performed poorly in recent times. Are we seeing a resurgence of prices there? What do you think, Andrew?
I did a presentation there around about a month ago, and there's certainly signs, particularly in that central Gold Coast market, of the prices starting to move off the bottom. Certainly the south and the north of the Gold Coast is still quite flat, and the unit market, not surprisingly, given that overbuilding that has been a feature of the Gold Coast market over the last 5 years or more, is keeping prices growth in units subdued. But certainly higher price brackets in the central Gold Coast region are showing some signs of life, and I think it's that value aspect that buyers are starting to realise this may be a really good opportunity to secure quality property in good locations at a price that's still below what they were 5 years ago.
Well, what do you think about that lower price unit market? Do you think that that's ever going to recover?
Well, look, it will. It's just a question of that oversupply working its way through the system. We're actually starting to see quite a lot of interest from international investors in the Gold Coast market. And of course, the thing that the Gold Coast has is the Gold Coast. I mean, nobody's going to take those beaches away. And it's one of Australia's, if not Australia's, premier tourist attraction. So there's a lot of a lot of work that's being done into that tourist industry in the Gold Coast that means that there will always be a continued drive in that part of the industry. So that'll always mean that holiday investment units will sooner rather than later start to pick up.
What do you think, Brad? What do you think about that market?
Look, I think over the previous period of time we've had things like a really strong Australian dollar, which hurts because no one goes to the Gold Coast anymore because it's cheap to go overseas on holidays. Yes, we've got and having travelled a fair bit around some of the world, I think Australia still has the best beaches, which the Gold Coast has. Although the weather's done a bit of damage to it over the last little while, it'll come back, and it's still just a beautiful place. Strong Australian dollar hurts the tourism dollar coming in from externally overseas, and also locally from Australia going to places like Gold Coast can suffer from something very similar, I think.
Yes, it does.
And I think that with it reducing a bit probably over the last short period of time, and not much construction happening since probably some of those things that were overdone in numbers, then eventually we've got to have some equilibrium, because I think unless they keep building, which they can't keep building because no one will buy, construction costs come up and follow up to a certain number, and it starts to become value based on, well, I'm going to buy it for $400,000 and it's a $350,000 build. It starts to look like good value, providing at some point that people are going to come and fill them up and you're going to get some rent for them.
It's an interesting market, and again, one that we do get a lot of questions about. And the other market, which is similar to that, but not the same, is the Sunshine Coast. And I guess we go to that now, Andrew, staying in that area, just to give the viewers an insight onto what you're perceiving as the movement on the Sunshine Coast. Is there any?
Yes, and it's very similar to the Gold Coast.
Right.
Properties in Caloundra, south of the coast, and Parige and Noosa to the north of the coast have definitely started to grow. More buyer activity from people looking at that value aspect of those quality products, of those quality properties, weekenders, holiday homes, and we are starting to see prices growth at the bookends of the Sunshine Coast market there, and they do represent very good value. Still around about 10% below their previous price peaks. So it's no wonder, given the nature of the location, that you're seeing increased buyer activity, as well as that lifestyle market activating again, generally in Australia as the economy starts to stabilise.
What about for investors? Are we really seeing the demand in terms of rental properties there? Are people moving to the Sunshine Coast now? Is there demand? Is the population growing?
I think it's more owner-occupiers or weekenders or retirees. I think that's very strong in Caloundra, the retiree market, as we know. And retirees have been impeded to a large degree by that underperforming stock market, which is also by underperforming housing markets over the last few years. So those retirees are getting ready to move on to warmer climates. They've had to put those plans on hold to some degree. But we're starting to see that released a little bit more now. Increased demand in those hotspots of Caloundra for retirees, and Parige and Noosa is a little bit more of the lifestyle weekender, holiday market and owner-occupier market.
Yeah, okay. What are you seeing, Brad? Are you seeing something?
The thing about the Sunshine Coast, or Noosa is particularly, I just love it. And I love the restaurants and the things that are right on the beach that sort of isn't repeated very well anywhere else on the coast, where
Yeah,
you're
I
actually
agree. I do like it
boardwalk,
myself.
etc. Now, if you get into Hastings Street and that, it's all ridiculously expensive for an investor's point of view generally, I think, but that's about a demand and supply thing, I suppose. You want to buy the best piece of real estate, you've got to pay the most money, I suppose, and then it becomes... and I've thought, maybe not so much there, of buying up there for the last 2 or 3 years. And I think I had a question on recently, one of the previous shows, and something's always sort of stopped me, and I'm not really sure what it is. Possibly time. But seeing some recovery is, I should have listened to myself and actually probably bought some there.
Well.
And if the prognosis going forward is good, which it probably is in some ways, then...
Well, I think it's a bit emotionally driven, isn't it? Because I mean, I've got a really good, strong attachment to that area too. So I think maybe you and I, even though we try to be very pragmatic about our property purchases, I think it might be an emotional.
And maybe what stopped me is trying to not make a decision on an emotional decision about buying something there.
Yes.
Maybe that's all it is.
Maybe it is. Look, we've got our first caller, and it's Diana, and she's from Perth, and she's calling about buying an investment property with positive cash flow. Diana, how can we help you? Hello? Okay, I think we've lost Diana, but we'll go on to the email. I'm hoping that Diana will call back. Our first email, it's one for you, Brad, and it's from Leslie, and she writes, hi panel, for tax purposes, can you depreciate a rental property if the property is a unit? How do you work that out? Leslie. Now, not a great deal of information in that particular email there, but can we give her some help?
Look, that's about all the information I need. So the important question there is that in order to claim depreciation in this country, it needs to be an income-producing property. You've called it a rental property, which means it's an investment or income-producing property, so the answer is yes. Definitely able to claim depreciation in this country. The question of how much, I suppose, is what it comes down to, and also a unit, which I'll touch on in a moment. But a lot of people think that old property doesn't get depreciation. Now, the fact that you've asked a broad question is you're thinking, do I get it on any unit that I buy? And the answer is yes, pretty much. Older property doesn't get as much depreciation.
Of course.
Definitely, because there's some rules that say you can or can't claim it depending on age for some things in the building, like the structure of the building. It needs to be built after a certain date in order to claim for that. Old property still gets some. We can put some value on things like carpets, fixtures and fittings and get some depreciation out of the older style properties. But then on a new property you get to claim on that structure as well. In a unit you also get to claim on in most states, some of the common areas. So you own part of the underground car park, lifts and things like that. So the short answer is yes, definitely. If it's a rental property, there'll be some depreciation. I mean, you can get some sort of indication what that might be before you buy it by, speaking to the guys in the office, and we'll give you an idea of what sort of dollars it can be.
But Andrew, you wouldn't just buy a unit just because you could claim depreciation, would you? It would be other reasons why you would buy the property. Depreciation not just being the only reason.
Well, it's part of the investment
the
process. It's part of the boxes that you tick in your decision making suite.
Yes.
So and it's why we have such a robust. One of the reasons why we have such a robust bricks and mortar investment culture in this country.
Yes, I think so too. All right, well, we have to take a short break, but stay with us. After the break, we'll be answering another email and, of course, taking your calls. So, Diana, please call us back. So join in the conversation by calling us on 1300 30 34 35 or emailing us at property@skynews.com.au. We'll be right back. Welcome back to the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery from Resi Home Loans, and tonight we're taking your questions and hopefully providing some answers to help you get ahead with your property investing journey. We've got two experts on the panel this evening. They are Brad Beer from BMT Tax Depreciation and Dr. Andrew Wilson from Australian Property Monitors. We would love to answer your questions, so pick up that phone and call us. The number's 1300 30 34 35, or, of course, you can also email us at property@skynews.com.au. So, while we're in the break, we were having a chat about the Sydney market and about how Blacktown's the new black.
Well,
sorry, Andrew.
Sydney's the new black, I think.
Sydney's the new black.
Blacktown, we're getting confused here.
Well, let's talk about this market, because I know a lot of our viewers are actually interested in buying in the western suburbs of Sydney, if not in Sydney itself.
Yes.
So let's talk about how it's performing at the moment, and we do have a question coming up that actually deals with that, but we can talk through that now. What are you seeing in terms of the hottest spots in the last couple of weekends of auction results?
Extraordinary.
Yes.
We're tracking at the moment in Blacktown. Well, in the west, we'll look at the west generally. Last quarter, nearly 5% prices growth over the quarter, September quarter, and 15% over the year. So we've seen house prices in the west rising by 15% and recently by 5% over the quarter.
Right.
So these are certainly once in a decade type price rises. And there is such demand for property in the western suburbs, not just from investors, but also from owner-occupiers who are being squeezed out of the more expensive places in Sydney and are looking for less expensive options. And of course, we have the political equation in the western suburbs of Sydney now. It's gentrifying. It's got to be taken it can't be taken for granted anymore. So we will see increased spending out there. People are starting to look differently at the West in terms of the commute, in terms of what it offers locally. So it's not just investors that are interested in the West, but certainly there's a lot of interest there. Demand is high and prices are rising very strongly at the moment.
Before we sort of drill down, Andrew, into some of those markets, Brad, confidence is back. There's absolutely no doubt about that. We've had a sustained period of low interest rates since November 2011. People are really enjoying that. What are you seeing?
I'm seeing that, I suppose. We in my business, we do depreciation schedule, so we tend to deal with the investor after they've gone to the accountant, you know, and it's always a bit behind. But I see, but just what I see in talking to people, because a lot of the clients we deal with are like I spoke to a couple of buyers agents, and they've just kind of given up on Western Sydney. I think I've been discussing on this show. Probably a lot of, you know, I believe in it as well, Margaret's recommendations on a lot of Western Sydney. But I think, seeing what I see at the moment, 85, 90-something% auction clearance rates, I think sometimes the herd mentality that property investors tend to get, where you actually follow everybody, means you start fighting with everybody. I probably have been thinking that's a good area to buy, but haven't bought, probably because of my land tax problem is a big problem for me.
Yes, of course.
But following when everybody's buying in those places means you're fighting with more people. You know, with lots of home buyers grants, I probably stopped buying a lot of the time in certain areas because I was fighting with them all the time.
Yeah, that's right.
And I think it's always a bit scary, and especially when we've got interest rates where they are right now, really low, the returns are good, but the higher the prices go, the less the yield looks like, and the cost of owning those properties at the moment is really low. You know, you take into account, you know, when you crunch your numbers on the property, it doesn't cost much to hold it. We're at all-time low interest rates. You've got to factor in, when you crunch your numbers, some higher interest if it comes.
Absolutely.
Or the question is probably more when it comes.
When it comes. And for people who haven't been in the market for very long, that is a really big factor. I think a lot of people are taking that into consideration, or the changing circumstances that may occur within their family unit over time. Because investing in property, whether it's your home to live in or whether it's an investment property, it's a long-term investment. And you need to be able to afford it now and into the future when interest rates do go up, or if circumstances change within your you know, your own circumstances.
Yeah, one of the couple has a child. That sort of impacts on the.
Well, it does. It does
income.
indeed. It does indeed. Well, look, let's go to our next email, because it does talk to this particular market, and it's from Andrew, and he writes, "Hi guys, I'm looking to buy another investment property, a 2 or 3 bedroom house in the Seven Hills Blacktown Laylaw Park area, and after missing out on a couple of deals, have found prices skyrocket in the last month alone. Am I right in assuming that there will be a correction when the supply finally comes to the market, or is this quick price hike as a result of pent-up growth and will likely plateau rather than correct in the coming months or next year? I don't believe the current prices on these properties in these areas are reflective of their underlying value. Thanks, Andrew." I think this is one of the best questions that we've had on the program for a long time.
Perceptive too.
I'll go to you first, Andrew. What are your thoughts on?
Well, look, it is perceptive. Look, the market value is what the market puts on a price. I mean, if people are prepared or can afford to pay a particular price for a commodity, a property, that's what its value is. Now, investment value, however, needs to be driven by fundamentals such as return, and return reflects the individual capacity of the investor. Now, if you are in a market where you're going short, for example, yields start to fall, vacancy rates start to rise, that's the market adjustment process. And that's when prices do plateau and supply and demand imbalances start to readjust. And that's possibly what we're going to see with this surge in investment. I call it the curse of the hotspot.
Yes.
Perhaps that's a little unkind, but it is, in a sense. We have seen markets that have gone ahead of their fundamentals and then they correct backwards. Now that's okay, because that's market forces working. But the problem is, if people go short in that environment, then there can be collateral damages to personal balance sheets.
Exactly.
That's the issue.
That's the issue. Are people paying overs in Western Sydney? That's the question, Brad.
Yeah, well, look, it's always worth what someone's prepared to pay for it. I guess the fundamental question of why they're prepared to pay, you know, seen some things in the, I see something in the paper about a property going for $1 million over the reserve. Someone thought it was worth $1 million less than someone's prepared to pay for it. Now, that's probably a one-off buyer, I suppose, but there seems to be many of those stories and a big clearance rate. But it comes down to, I guess, that property's back, the flavour is back again. It's been, bubbling away for some time, but then we had the election where no one does anything for a period of time until someone makes a decision on who runs the country, and things like that. And maybe some of that is pent up when there is a bit of positivity in the market. I've been seeing positivity in the market in Sydney for a little while, though. So I think the fact that interest rates are so low, are we getting a bit too excited? Are we buying something and thinking I've got to fight with everyone and getting at the auction process and going, well, I need a property, and be careful that the numbers actually work when you do crunch them with the interest rates a little bit higher. And maybe if you're a home buyer, you need somewhere to live, but maybe as an investor, you've got to look in the areas where it's going to stack long term and you're not fighting with everybody all the time.
I agree. I do want to talk to you, Andrew, about what might happen leading up to Christmas, but let's go to our caller, Wayne. Wayne's from Brisbane. Wayne, how can we help you this evening?
Hi guys, thanks for taking my call. I own 2 investment properties. I had them for over 10 years and I'm considering selling one of them. And I just wanted to clarify the establishment of the capital gains tax in the sense that having claimed the construction cost of 2.5% over 10 years, plus fittings and fixtures over that same period, how does one establish after you've sold it, the capital gains tax? I'm aware of the 50% reduction, but I just want to clarify the items and how you come to your base cost before you make your capital gains assessment.
Wayne, when was the property this was a property you built?
No, purchased.
You purchased it. When did you purchase it?
In 2002.
2002, and it's always been an investment property?
Correct.
Okay. I'll go straight to you, Brad, on this one. Your thoughts?
Look, it's really an accounting question, that one.
It is indeed.
However, as the Quantity Surveyor, I get asked it every second day because people are getting depreciation schedules and going, how is that going to affect my capital gains tax? I will, probably a good way to work that out. The last newsletter we wrote, we did a detailed analysis that was checked out by an accountant to say what happens if you don't claim depreciation to the numbers. But effectively your cost base will be reduced by what you've claimed on that building allowance, and there'll be an adjustment in relation to the plant and equipment you've claimed as well. You will get a 50% reduction on the capital gains tax that you do pay, and you've made those claims on the way through at your full marginal tax rate. So generally when you work it out, it's still better to claim it than not claim it, but it will definitely affect it. The numbers are on that, or it's really off to the accountant with your specific scenario. You're after the 85 CGT date, so being an investment property, you will be up for it, most definitely. I guess the good thing is at least it's a time when you do sell it, and hopefully you've got some of the money and the proceeds and the gain that's actually been made at that time.
Let's hope. Andrew, any further thoughts you want to add to that?
No, not really. I think Brad's covered that with his expert insights better than I could ever do.
Oh, very good, Brad. Well, other than just to say to you, Wayne, that it is very important that you get some independent advice on this one, and Brad's absolutely correct. We can give you some guidance here, but certainly you do need to go and see your accountant, make sure that you do have your ducks in a row on that CGT issue. Well, there's still plenty of time left, and if you have a question for anyone on the panel this evening, all you need to do is call us on 1300 30 34 35 or email us at property@skynews.com.au. We're off for a short break, but don't go away. We'll be right back. Thanks for staying with us. You're watching the Monday night property edition of Your Money, Your Call. I'm Lisa Montgomery, and we've been getting through some great questions tonight and hopefully offering a few insights into how you can become a more informed property purchaser, seller or investor. If you call or email tonight, you'll be speaking with Mr Brad Beer from BMT Tax Depreciation and Dr Andrew Wilson from Australian Property Monitors. So all you need to do is pick up the phone and call us on 1300 30 34 35 or email us at property@skynews.com.au. So before the break we were talking about Sydney, and particularly the western suburbs.
Yep, go west, young man.
Yes.
Or woman.
Man or woman. The lead up to Christmas,
Yes.
is that going to change the dynamic of the activity that we're seeing at the moment? I mean, people are, as we've said, they're moving in herds to buy in the western suburbs. Are they going to continue to do that up to Christmas?
Well, let's be clear where the market is in Sydney at the moment. It is at unprecedented levels. The auction clearance rate over September in Sydney was the highest ever recorded in any month. We're starting to see now record numbers of listings coming through. So people are deciding now's the time. So not only clearance rates, buying activity is at record levels, we're now moving with seller activity at record levels. So it's not just a product of low volumes here. It's certainly a lot of energy in that market.
There is.
Yes.
But will it continue?
Well, look, long-term studies by the Reserve Bank and most that have insights into the housing market show that really in Australia, house prices do follow income. So disposable income levels follow house prices over time. So yes, the market does move ahead of itself, and that's a business cycle. Not a bubble, a business cycle. And then it adjusts as the underlying fundamentals work themselves back into what the underlying market should be producing. So if we go up a little high, we come down a little bit. And I think that's what will happen next year. We've still got some dark clouds on the horizon as far as the economy is concerned.
Yes.
Unemployment is significantly higher now than what it was a year ago.
Yes.
We're still a little mixed as if it's going to go lower or higher. But the Reserve Bank, the Treasury, has predicted unemployment to rise to 6.25% over the financial year. If that happens, it'll be the highest unemployment rate in Australia for 10 years.
Yes.
Now, they are not conditions conducive to a housing boom.
No, they are not. And that word boom is being bandied about all sorts
It's very
of places.
exciting, isn't it? And we all pick it up and, wow,
Yes.
let's read about the boom. Because a year ago we were reading about the bust. So,
It's nice to have a boom
It's
back.
nice to be excited, isn't
That's
it?
right, it is indeed. Look, we're hearing some information at the moment about about yields and yields being lower in certain markets.
Yes.
What are you seeing, Andrew?
This is the first process of that adjustment
Yes,
scenario.
I thought
We're
you might
starting to
say that.
see yields fall in Sydney. And it's not just because of prices growth, we're seeing rents fall too.
Yes.
Or not fall, we're seeing rents flatline, prices rising strongly, yields are coming down. So is that an incentive for new investment? I don't think so.
Yes, no, I don't think so either. Look, let's go to our next email, and it's from Dave. And Dave is asking about investing in Adelaide, and he writes, "Hi panel, I have $300,000 in my self-managed super fund, mostly in shares. I live in Perth, where I am paying off the family home. I'm considering investing property in Adelaide with my super for some diversity. Could you suggest any growth areas with lower entry levels for me to investigate further? Many thanks, Dave." Now, before we move into Dave's question, I think what might be very good is to just clarify that with our advice piece on this program, it's important for us not to give too much in-depth advice, and particularly with Dave investing out of his superannuation fund, I think we need to clarify that anything that we do say will be just general in its delivery. So let's go to you, Andrew, first. What are your thoughts?
I did a presentation in Adelaide just recently too, so I have some info on Adelaide. The Adelaide market is characterised by being a flat market that doesn't have the same sort of peaks and troughs as other capital city markets do have. Having said that, however, it's a secure market in that sense. So if you're looking for a diversification into a conservative market such as Adelaide, perhaps that's a good starting point. Now, some growth recently in the Adelaide market is to Metro North, which is some of those areas like Modbury, Windvale to the north, where we're starting to see some prices growth coming through. So a conservative market, but a market with some sense of security going forward.
Do you think, with the fact that that folks have only $300,000 in their self-managed super fund, do you think it's actually wise for them to be moving into property with that amount of money in the fund?
As you've mentioned, I'm not here to provide financial advice.
No.
But if a diversified portfolio means investment in property, then Adelaide is a conservative market,
Yes.
and there are entry-level properties to the north of Adelaide which are showing good value and some modest returns at the moment.
Yes, I agree. All right, the questions and the conversation have been great so far this evening, and there is still time for you to join in. So send us a question at property@skynews.com.au or call us on 1300 30 34 35. It's time for another short break. We'll be back in just a moment. Welcome back to Your Money, Your Call. I'm Lisa Montgomery from Resi, and with me tonight on the panel is Brad Beer from BMT Tax Depreciation and Dr. Andrew Wilson from Australian Property Monitors. There's still some time left for you to call us and ask us any question about property, finance or depreciation, and you can do that by dialing 1300 30 34 35 or email us at property@skynews.com.au. I think for reference, if anyone's watching the program and we go to the wide shot, everyone's going to notice that Brad's not here now. And we've lost Brad, but he will return, I'm sure, toward the end of the program. So if you do have a depreciation question, hold on to that. Before we go any further and answer any more emails, let's talk a little bit about that Melbourne market now.
Yes.
Because that's another market that's causing a little bit of chatter in the media at the moment, and particularly about the oversupply or potential oversupply in and around the CBD.
Yeah.
What are you seeing of the trends in Melbourne?
Look, Melbourne's a very even market, Lisa. It's not quite as strong as Sydney at the moment. It's sort of solid to strong. Its clearance rates are around about, well, they're not quite where they were in 2009-10 when there was a very strong prices boom there. But nonetheless, they're very solid in those mid-70% marks. And auction clearance rates are a very good indicator of the underlying activity in the market. But certainly, as you mentioned, that inner city unit market, there has been unprecedented construction, planned construction of high-rise apartments in the CBD, and we are starting to see unit prices falling as a consequence. Now,
Interesting.
Melbourne has a history of oversupplying that high-rise market. It happened in the Docklands and South Bank 10 years ago, and perhaps it's happening again now. But certainly it's providing a lot of economic activity to the local economy through the construction industry, and that's a positive.
Yes.
But down the track, of course, you know, we need to have people living in these apartments.
We do.
And you know, oversupply of apartment markets is not an unusual occurrence, and it's happening in Melbourne. But generally, the most of or all of the Melbourne market is rising again. We would see perhaps about 8-9% prices growth in Melbourne this year. But we must remember that Melbourne is just catching up to where it was 3 or 4 years ago. So it's that value orientation that buyers are saying, hey, property here is the same price as it was 3 or 4 years ago. And we're starting to see some of those middle ring, mid-price range suburbs get a lot of buyer activity. And that's where we're seeing the highest clearance rates at the moment, particularly in the outer east of Melbourne. And prices are growing there. But they are growing back to where they were 3 or 4 years ago.
It's interesting to put that in perspective, isn't it? Because we have had a couple of years of really flat
That's right.
pricing, and now we're actually seeing some movement there. I think for some people it's you know, it's kind of cause for alarm, but it's not. It's what natural property markets do, and that is that they grow.
Yeah, it's just a business cycle, but it's the property business cycle. And it moves ahead as confidence rises, just as it moves backward as confidence falls. And of course the catalyst is these 60-year low interest rates at the moment. But we must remember that unemployment is pushing up towards 6% at the moment. We're still seeing low retail sales. There's not a lot of positivism underlying the Australian consumer at the moment. Still a little wary, I think, still a little conservative, that Australian consumer. So it's exciting at the moment. Spring is in the air in Melbourne. Everybody's at auctions buying and selling.
They are.
But I think come Christmas, we just might start to see a plateauing of that activity, which will be healthy moving into the new year, which still should be strong. But I think by mid-year, we need to watch where the economy is going to get a sense of whether the market can substantiate the sort of activity that's happening there at the moment.
And we might see some people going to the beach on a Saturday instead of attending the auctions that are at there.
It'd be a wonderful change for me.
It might indeed. Look, to our next email, and it's from a frustrated first-time buyer, and it's Lachlan, and he writes, Dear panel, my partner and I are first home buyers in Toowoomba, Queensland. I agree with your lead story a few weeks ago that investors are taking over the market. Every time I go to look at a property, it tends to be under contract. As a first time home buyer, what advantages can I leverage to increase my chances of obtaining the property I want? Furthermore, is Toowoomba's property market too hot to buy at the moment, and should I rent instead? Thanking you, Lachlan. Now, we've had some great questions tonight, and this is another great one. And I think there's a few pieces in here, Andrew, for us to address.
Yeah.
Obviously, you know, how does a first-time buyer compete with that investor, the number of investors out there at the moment, the Toowoomba market, and there is some heat in that at the moment.
Oh, yeah, absolutely.
And he's saying, you know, should I rent instead? So let's just sort of break that down a little bit. Let's look at Toowoomba market first and foremost.
Well, I was afraid of this because Toowoomba has been, I guess, flown under the radar a little over recent years. Now, Toowoomba is clearly Queensland's, or the least expensive, the most affordable at this point of Queensland's regional markets, major regional markets. But Toowoomba is the gateway to the Surat Basin.
It is.
So it is acting as a hub for residential activity from people who are working in the Surat Basin. So it's a new Gladstone in that sense. And it's getting the curse of the hotspot, right? This is what we don't want to see, where, as we've said, supply or demand moves well ahead of supply, or in this case, supply of rental properties moves well ahead of underlying demand, and then there's an adjustment process. I am very confident about the prospects generally for the Queensland economy next year. I think that South East Queensland and Queensland generally is a very good prospect for having perhaps the most resilient and robust housing markets next year for a number of reasons. And I think Toowoomba is a part of that equation. I still think there's some upside to the Toowoomba market, but if you're an owner-occupier in there for the long haul, then I think buying is better than renting. I think the issue here is with the investor. And when they enter the market. But I think for the owner-occupier in Toowoomba, given a better outlook for the Queensland economy next year, and we've got to remember those Brisbane median house prices are still 7% below where they were 3 or 4 years ago.
That's right.
Plenty of upside there, and that Queensland economy is really due to take off.
I agree with you. I'm just wondering about Lachlan and his issue of getting ahead of those investors. What can Lachlan do to actually be one of the first people that sees a property?
Well, look, it's just like anything. I mean, you've just got to pay what the market is asking you to pay.
Yeah.
And over time, as an owner-occupier, and it's not, you're not sitting on a pile of money, you're living in a house with a roof, okay? And that's what you've got to do whether you're renting or buying. So it has that purpose for you initially or fundamentally. So, but I do think for Toowoomba is still a very good prospect going forward, as are most Queensland markets.
Well, let's hope that helps you, Lachlan, in your buying journey in Toowoomba. Well, there's still time for you to ask your question this evening, even though there are only 2 of us left. So if you would like to join in on the conversation, pick up the phone and call us on 1300 30 34 35, or send us a question at property@skynews.com.au. Time for another short break. We'll be back in just a moment. Welcome back to Your Money, Your Call. I'm Lisa Montgomery from Resi, and doing a sterling job this evening is Brad Beer from BMT Tax Depreciation, who is back, and Dr. Andrew Wilson from Australian Property Monitors. And if you would like their help with your property investing questions, simply call us on 1300 30 34 35 or email us at property@skynews.com.au. Brad, you're back. It's good to have you back. Not trying to confuse the viewers out there, but Brad is back. So now that you are back, Brad, let's talk about the Perth market, and I might go to Andrew first on this.
Yes, well, we were fortunate having a doctor handy.
Yes, that's exactly right. So Andrew,
the Perth market,
what's happening in Perth at the moment?
Very interesting market. Of course, Perth was the leader of the pack over the last 12 to 18 months in terms of that housing market revival. We saw almost 2 years of consistent quarterly growth from the Perth market, and it looked like it would record something up towards 15% growth this year. But all bets are off at the moment. We're starting to see a plateauing of Perth housing market price growth and buyer activity. We're also seeing those skyrocketing rents in Perth, no surprise, starting to come back to something a little bit more rational. Perth was challenging Sydney as being the most expensive place
It was.
to rent a house or a unit. So they were getting double-digit annualised rental increase, and of course that can't be sustained. So we're starting to see that now moderate, but we're also seeing house price growth moderate. In fact, our latest data has shown that it has flatlined over the last quarter, Perth house prices. So part of that adjustment process,
Of
again,
course, yes.
the market moves ahead of itself, takes a breath, it pauses back to the fundamentals, and those fundamentals, of course, are supply and demand factors, and they're principally driven by the nature of the local economy.
Are you seeing any particular suburbs at the moment which still have a little bit of heat in them?
No, look, I think generally Perth is still has an upside to it, and I think this is more a pause than anything else, and
Right.
it's a healthy outcome.
Yes.
Because, look, we've got to remember that Perth was, some were suggesting was there were 12 to 1,500 people every week moving into Perth. Now, Perth really hasn't built any houses for the last 4 years. So, it's that supply side constraint, again, that put pressure on rents.
Yes.
Perth actually has a lot of first home buyers. It has one of the highest proportions. In fact, it has the highest proportion Western Australia of any first home buyers. And that, of course, is the disincentive to rent. Pushes them into the buying market. So look, it's still quite healthy there at the bottom end in Perth. I just think it's taking a pause, and we'll wait to see how the general economic issues pan out in terms of prices growth next year.
Great. Okay, Brad, your thoughts on Perth?
I think, I think at one point, for example, I think the median price overtook Sydney for a period of time. And fundamentally, I think that's probably not right. And you look at our country, and Sydney usually leads the pack, which is probably one of the reasons for the last 12 months or 2 years there's been there's not an equilibrium of what the prices are in these areas based on what they are. Sydney's usually at the front and Perth's not, and it has been, which is always, I guess, a concern. Then I think that some of the hurt comes down to everyone a few months ago started deciding the mining boom was over.
Yes.
And the media probably pushes that to the point where it looks like it is over. We're still digging things out of the ground.
Yes, and we'll continue
we're a
to
bit
do so.
expensive,
And
we'll continue to do so. So I think it's probably got some things there that'll mean it'll still be able to perform in some way. But because it's been cooked so hard, it's just got some time to come back, I suppose.
Yeah, I agree with both of you. Okay, well, let's go to another email, and it's an interesting question from Josipa. Dear panel, my son would like to buy a house in Sydney close to the CBD, Annandale area, to live in it. He can borrow $600,000, however decent properties there are more than $800,000. My husband and I would like to help. We are thinking of buying a property in multiple names. Example, he pays 75% and we pay 25%. Is that a good idea? Can 25% of the house be claimed as an investment? Any advice of what we should do? Thanks, Josipa. Is that Josipa? Okay, I'm going to go to you first, Brad, on this one. What are your thoughts on what Josipa should do?
Look, it's not, we're talking about investment properties most of the time here tonight, and this is a home purchasing decision, so it's obviously looking at something that is where you want to live. So then it becomes a point where you sort of, if I was buying an investment property and I can borrow $600,000 and it's $800,000, I'd look at somewhere else.
Yes.
But if you want to live there, you've got the renting option, I suppose, and buying investment properties elsewhere, which is always something to explore. But your main question is around the percentage of ownership, and going into property in partnership with anybody is always fraught with some potential dangers. What some people want to do in a period of time may change. The son could get married, have children, all those sorts of things are going to change your situation. You might want to get out of that property and he still needs to live there, for example, get out of that as a sale. Can you claim can it become an investment property? Well, your percentage of it, providing it's a fair market rental for that percentage that he's paying, then you're effectively a 25% investor in that property. So you should be able to make claims. Depreciation applies at a percentage, etc. You've got a capital gains tax issue potentially with that, and it all gets a little bit messy. But if that's the only way for him to get into that property, it is a way for you, as obviously older than your son, to help out with the ability to get into some ownership. And it's a bit safer probably than just loaning the money, because at least you're taking some positive on the gain that potentially comes out of the property in the future.
I agree with you. Andrew, look, I'm not a big fan of this type of arrangement for many reasons, because I've been in the finance biz for over 30 years, but and I'll go into what I think about that in a minute. But what are your thoughts on this?
Well, look, as far as investment advice, that's probably not my spin. But the first thing is why did he have to buy something in Annandale? So he's got 800 grand to spend.
That's right.
Surely, I mean, you can get quite a nice unit in Pyrmont, Annandale, Ultimo, Alexandria. It's a question of preferences, I guess, or moving out a little bit further from the CBD to get something that can meet your budget, rather than having to move into these type of arrangements, which, as Brad said, perhaps are problematic going forward.
Exactly.
And as I said, for $800,000, you can still buy a unit, quite a nice two-bedroom unit, within 5 k's of the CBD.
Absolutely. Josipa, I actually agree with both of the guys on the panel tonight. I strongly recommend that you think about this quite carefully. Often too, when you mix the purchase of a property with a family unit, even though it can help that property to be purchased, sometimes the long-term issues can be significant. Sometimes also parents feel that they have a certain ownership over the property and want to influence how that property is developed or renovated, or how that property is actually used over time. I think the other thing too is that sometimes it can impede things that you might want to do yourself. If you want to make other investments, or perhaps you might want to retire and you need that money, it's hard to get that back out of that property. I think it's very lovely of you to try and help your son, but I think if there's an opportunity for him to buy a cheaper property whereby he's purchasing that 100% himself, I think that's a better opportunity. Okay, well, it's time for another short break, but there's still time for you to ask your question. So please join in on the conversation. We'd really love a phone call, so if someone would like to call us, you can do so on 1300 30 34 35, or send us a question at property@skynews.com.au. We'll be right back. Welcome back to the property edition of Your Money, Your Call. I'm Lisa Montgomery from Resi, and with me in the studio is Brad Beer from BMT Tax Depreciation and Dr. Andrew Wilson from Australian Property Monitors. And if you would like their help this evening, simply call us on 1300 30 34 35 or email us at property@skynews.com.au. But you better be quick because the show's almost over. Guys, let's just have a quick chat before the show has finished on what we think is going to happen with interest rates on Melbourne Cup Day. I mean, that's the next decision.
Yes.
What are your thoughts, Andrew?
Well, look, traditionally they cut or raise interest rates on Melbourne Cup Day. Last year they broke the tradition, the Reserve Bank. I still think we're balanced between optimism and pessimism as the outlook of the economy. So rates will likely stay flat. Wasn't really good news on the unemployment rate last week.
No.
So we're still on watch. I'm not convinced that they won't go down again, so perhaps one more cut. But I'm certainly not, I cannot see an interest rate rise on the horizon anytime soon.
No, I agree with you. Your thoughts, Brad?
And look, I think the RBA, there's a lot of positivity in the property market at the moment, and people are buying on the low interest rates, etc. But the RBA, people do a lot of economic calculations and are still scared of something a little bit. So it's always a reason to be a little bit cautious, because they do a fair bit of analysis and don't just make these decisions based on nothing. So I'm thinking, they seem to be still worried from what I hear in the media. Probably a stay would be my call, I suppose.
What do you think another cut, before Christmas might do to the property market, those hot markets, that is?
Well, I suppose it fuels the fire a little bit because it looks a little bit cheaper. But I still think it's always got to be a cruncher to crunch the numbers in assuming it's going to be higher.
Yeah.
And see if it still works for you.
Yeah, I think so too. All right, well, that's all we have time for this evening. Thank you so much for joining us. And my thanks also to my wonderful guest, Brad Beer from BMT Tax Depreciation, and Dr. Andrew Wilson from Australian Property Monitors. Michael Tees will be in the chair next Monday filling in for Margaret. He'll be joined by Peter Kalouzis and Rich Harvey, so make sure you tune in. And make sure you tune in to Dr. Andrew Wilson's new program on 2UE. It's a property program from 2 to 3 on a Saturday afternoon with Tim Webster. So make sure you're listening in. It's going to be a great new show. I'm Lisa Montgomery from Resi Home Loans. Enjoy your week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for